Hello everyone and Happy New Year. It's 2025, can you believe it? Here's to a healthy and profitable year for you. Speaking of profits, let's talk about something that's been making headlines and causing quite a stir in the financial world. Cryptocurrency. Bitcoin and Ethereum, or Dogecoin. These digital currencies have taken the world by storm, but are they really the future of finance? What even are they, and how do they compare to more traditional assets like land or gold? That's what we're diving into today. Let's start with what we know. For centuries, tangible assets, things you can physically touch and hold, have been the backbone of wealth. Real estate cannot be lost or stolen, nor can it be carried away, said Franklin D. Roosevelt. And he wasn't wrong. Land, the ultimate tangible asset, provides the food we eat and the space we live on. It's finite, as Mark Twain famously quipped, "Buy land, they're not making it anymore." Then there's property, built on that very land, offering shelter and security. These assets have intrinsic value. They serve a purpose beyond just holding monetary worth. And let's not forget gold. Gold is money, everything else is credit, J.P. Morgan famously stated. This precious metal has been the store of value for millennia, a hedge against inflation, and a safe haven during economic turmoil. Of course, even tangible assets are subject to market fluctuations. Commodities like oil and wheat, essential for our world, see their prices rise and fall based on supply and demand. As Jim Rogers, the famous commodities investor, once said, "The price of a commodity will never go to zero." Basically, when you invest in commodities, you're not betting against or for the success of any particular company. Now let's enter the digital realm. Cryptocurrencies, unlike tangible assets, exist purely in the digital space. Bitcoin, the first and most famous cryptocurrency, burst onto the scene in 2009. Bitcoin is a remarkable cryptographic achievement, noted Eric Schmidt, former CEO of Google. Its decentralized nature, operating outside the control of governments and financial institutions, was revolutionary. Edmund C. Moy, the 38th director of the United States Mint, even acknowledged, "I think that Bitcoin has captured our imagination." Then came Ethereum, a platform that went beyond just digital currency. Ethereum allows for the creation of smart contracts and decentralized applications, paving the way for the rise of DeFi, or decentralized finance, and NFTs. As Vitalik Buterin, Ethereum's co-founder, put it, Ethereum is a more general-purpose platform. Technically, it allows people to build any kind of decentralized application on top of it. Thousands of other cryptocurrencies have emerged since, each with its own unique features and promises. Some are focused on privacy, others on speed, and still others on specific use cases. But here's the catch about cryptocurrencies. Their value is largely based on belief. Belief in the technology, belief in its potential, and let's be honest, belief that someone else will be willing to pay more for it in the future. As Nava Ravikant, who is a prominent crypto investor, once tweeted, "Bitcoin is a bet against the modern monetary system." This speculative nature has attracted both fervent supporters and skeptical critics. Finance mogul Warren Buffett even famously compared Bitcoin to rat poison squared. The crypto time bomb. What could trigger a collapse? While tangible assets are deeply rooted in the physical world, cryptocurrencies are inherently vulnerable to external factors, often beyond our control. Remember the flood in China's Sichuan province in 2021? It crippled Bitcoin mining operations, causing the price to plummet. Internet outages, government regulations, and even technological glitches can send shockwaves through the cryptocurrency market. El Salvador's adoption of Bitcoin as legal tender was a landmark moment. However, it also highlighted the challenges of integrating cryptocurrencies into existing financial systems. And let's not forget the infamous DAO hack of 2016, where millions of dollars worth of Ethereum were stolen. This event shook the crypto world, exposing the vulnerabilities of smart contracts and decentralized platforms. Looking ahead, the potential threat of quantum computing looms large. Quantum computers, with their unparalleled processing power, could potentially crack the cryptographic codes that secure cryptocurrencies, putting the entire ecosystem at risk. Even without these external threats, the cryptocurrency market is inherently volatile. We saw this during the Terra Luna collapse in 2022, an event that wiped out billions of dollars and left investors reeling. Bear markets are a fact of life in the crypto world, testing even the most seasoned investors' resolve. So, tangible assets or crypto? Where does this leave us? Tangible assets, with their historical significance, intrinsic value, and real-world applications, offer a sense of stability and familiarity. They are the cornerstones of our physical world and will likely remain so for generations to come. Cryptocurrencies, on the other hand, represent the future. A future of decentralized finance, innovative technologies, and potentially a more equitable financial system. But with this future comes inherent risk, volatility, and uncertainty. The key takeaway? Don't put all your eggs in one basket. Diversification is key to any sound investment strategy. Learn about both tangible assets and cryptocurrencies. Do your own research, understand the risks, and invest responsibly. And hey, if you want to learn more about navigating the exciting world we live in, hit that subscribe button. You won't regret it.